why do we need an index? Let's just try to understand this with a problem statement. Let's say you had to give a real-time situation update of the traffic in the city. Now, how would you do that? There are thousands of roads, there are a gazillion vehicles. There is no one number you can reach. One of the things that we could do is, now this is of a lot of solutions, this is one solution that we could think of. We would say there are 200 intersections in the city, and out of which the number of intersections that are jammed will determine how busy is the traffic right now. Let's say 5 intersections out of 200 are jammed. It's not a very busy day. But more than 100 intersections in the city are jammed. That would mean the traffic volume is extremely high. A concept that is very similar applies to stock market indexes. In case of markets, you essentially identify few companies to represent the broader market. Every time someone asks you how the markets are doing, you would just check the general trend of these selected stocks and then answer. These companies that you identified collectively make up the stock market index. So, you do not actually have to check every individual company and how they are performing. The most important companies are pre-packaged and continuously monitored to give you this information of how the markets are doing. These pre-packaged market information is called the market index. There are two main market indexes in India, indices in India, the S&P BSE Sensex representing the Bombay Stock Exchange and CNX Nifty representing the National Stock Exchange. S&P stands for Standard & Poor's, a global credit rating agency. S&P has the technical expertise in conducting index, which they have licensed to the BSE. Hence, the index also carries the S&P tag. CNX Nifty consists of the largest and most frequently traded stocks within National Stock Exchange. It is maintained by India Index Services and Products Limited, IISL, a joint venture between the National Stock Exchange and CRISIL. In fact, the term CNX stands for CRISIL and NSE. An ideal index gives us minute-by-minute real-time reading about the market participants' perspective of the future. The movements in index reflect the changing expectations of the market participants. When the index goes up, it is because the market participants thinks the future will be better. If the index drops, the market participants perceive the future pessimistic. Now, practical uses of index. First is information. The index reflects the general market trend for a period of time. The index is a broad representation of the country's state of economy. A stock market index that is going up indicates people are optimistic about the future. Similarly, when the stock markets go down, people are pessimistic about the future. Benchmarking. For all the trading or investing activity that one does, a yardstick to measure the performance is required. Assume we have invested X amount of money and generated 20% money as return. That makes your corpus 1.2 times. Well, on the face of it, 20% returns look great. However, if the Nifty moved 7,800 points from 6,000 points, generating a return of 30% in the same year, well, suddenly it may seem that you have your stocks or your portfolio has underperformed the market. If not for the index, you can't really figure out how you have performed in the stock market. You need an index to benchmark the performance of a trader or an investor. Usually the objective of market participants is to outperform the index. Trading on the index is probably one of the most popular uses of the index. Majority of traders in the market trade the index. They take a broader call on the economy and general state of affairs and translate that into a trade. And finally, portfolio hedging. Investors usually build a portfolio of securities. A typical portfolio would contain 10 to 12 stocks, which would generate them returns in the long-term perspective. While the stocks held are for a long term, they could foresee a prolonged adverse movement in the market. For example, the stock market crash from 2008 that could potentially erode the capital of the portfolio. In such a situation, investors can use an index to hedge the portfolio. It is very important to understand how an index is constructed or calculated for a trader to succeed. As we discussed, an index is a composition of many stocks from different sectors that collectively represents the state of the economy. To include a stock in the index, it should qualify certain criteria. Once qualified as an index stock, it should continue to qualify the stated criteria. If it fails to maintain the criteria, the stock gets replaced by another stock that qualifies the prerequisites. Based on the selection procedure, a list of stock is made. Each stock in the index should be assigned a certain weightage. Weightage in simple terms is how much importance a certain stock is given in the index compared to the others. Let's say there is stock X that has a weightage of 10% of a certain index. Then that would mean that the movement of that index, 10% of movement of that index can be attributed to the stock X directly. The obvious question, how do we assign weights to the stock that make up the index? There are many ways of assigning weights, but Indian Stock Exchange follows free float market capitalization method. The weights are assigned based on companies' free float market capitalization. The larger the market capitalization, the higher is the weight. Free float market capitalization is the product of total number of shares outstanding in the market and the stock price. Sector-specific indices. While Sensex and Nifty represent broader markets, certain indices represent specific sectors. These are called the sectoral indices. For example, Bank Nifty on NSE represents the mood of specific to banking industry. The CNX IT on NSE represents the behavior of the IT stocks in the stock market. Both BSE and NSE have sector-specific indexes. The construction and maintenance of these indices are similar to that of the major indices. So let's sum it all up. An index acts as barometer for the whole economy. An index going up indicates the market participants are optimistic. An index going down indicates that the market participants are pessimistic. There are two main indices in India, the BSE Sensex and NSE's Nifty. The index can be used for a variety of purposes: information, benchmarking, trading and hedging. Index trading is probably the most popular use of the index. India follows the free float capitalization method to construct the index. There are sector-specific indices which convey the sentiment of specific sectors.